If you have ever traded gold, you probably experienced something like this. You take a trade, everything looks perfect, the setup is clean, and then suddenly gold spikes in the opposite direction, takes your stop loss, and only a few minutes later moves exactly where you originally expected it. It almost feels like the market is targeting your stop loss. But what if I told you that what looks random on the chart is actually very structured? After years of trading gold and watching thousands of trades play out, you start to notice that gold actually moves in very predictable ways. Not predictable in direction every time, but predictable in behavior. And once you understand how gold tends to move, the chart starts to look very different. So in this video, I want to show you how gold actually moves and why many traders misunderstand it. Gold is not just another forex pair, it behaves differently. Currencies often move slower and more structured. Gold, on the other hand, reacts extremely fast to liquidity, news and sentiment. It is one of the most traded assets in the world. Central banks watch it, institutions trade it, and retail traders love it because the moves can be huge. But the volatility of gold also means something important. Gold is constantly trying to search for liquidity, and if you do not understand how liquidity works, the chart will often feel chaotic. That is why so many traders feel like gold is unpredictable. In reality, the market is just doing what it always does. It moves towards areas where liquidity exists. If you study gold charts long enough, you will notice that many moves follow the same three phases. First phase is accumulation. This is when price moves sideways for a while, the market looks slow, many traders become bored, but during this time, liquidity is building on both sides of the range. Stops are building above the highs and below the lows. The second phase is the liquidity grab. Price suddenly breaks the range, it might break above resistance or below support. Traders think the breakout has started, but often this move is exactly the market collecting liquidity. Stop losses get triggered, new traders jump into a breakout, and once enough liquidity has been collected, the market enters the third phase, the expansion. This is where the real move begins. Momentum increases, volume increases, and gold can move very aggressive in one direction. Many of the biggest moves on gold follow this basic sequence: accumulation, liquidity grab, expansion. Once you start recognizing this pattern, the chart stops looking random. One of the reasons traders struggle with gold is that they often enter at the worst possible moment. They enter right when liquidity has been taken. For example, imagine a strong resistance level that everyone sees. Many traders will place buy orders above that level, expecting a breakout. But often the market will break slightly above the level, trigger those orders, and then reverse. To the trader, it feels like manipulation, but in reality, it is simply liquidity being taken before the real move begins. The market needs liquidity to move, and obvious levels tend to contain a lot of it. This is why experienced traders rarely chase breakouts blindly. Instead, they watch how price behaves around those levels, because the reaction around liquidity often tells you more than the breakout itself. Another thing that surprises many traders is how fast gold can move. You might see a move of 50 or even 100 pips happen very quickly. These are a few reasons for this. First, gold is highly liquid, large amount of capital moves through the market every day. Second, gold reacts strongly to macroeconomic news. Inflation data, interest rate expectations, central bank decisions, and all of these can create sudden bursts of volatility. And third, when liquidity levels get triggered, a chain reaction can happen. Stop losses trigger, breakout traders enter, momentum traders join the move, and suddenly the market accelerates. Understanding this helps traders stay calmer during fast moves. Because when you know why something happens, it stops feeling random. One of the biggest improvements traders make is when they stop trying to predict every move. Instead, they start focusing on understanding how the market behaves. Gold does not move randomly. It moves between areas of liquidity. It reacts strongly around key levels and it tends to expand after periods of consolidation. Once you understand those behaviors, trading becomes less about guessing and more about observation. Gold will always be a fast and sometimes aggressive market. But the traders who succeed are not the ones trying to predict every candle. They are the ones who understand how the market moves. They study how liquidity works, they watch structure, and they stay patient while the market sets up its next move. Because once you understand the behavior of gold, the chart starts telling a completely different story. If you want help applying these concepts in the real market, you can join our Telegram community. Inside the group, we share daily trading signals together with full analysis explaining why the trade has been taken. You also get access to a personal trading coach who is available around the clock to help answer questions. On top of that, there is a full training course with more than 10 hours of material covering everything from beginner to advanced strategies. And for those who want an automated approach, we also provide access to our trading bot. If you want to check it out, you will find the Telegram link in the description below.